Hi, my name is Rod Gravelet-Blondin. I'm with the Commodity Division here at the JSE, and we're here to look at a little bit more about the grain futures and options, the derivative market in agriculture. For many years, agriculture in South Africa was actually regulated by the government, and we had a major change in '95 when the government withdrew from agriculture and the agricultural marketplace became pretty much a free market for those participants. And what did this bring? This brought price risk into the equation. So before, and agriculture has always been a risky business, before you had production risk, and you had to look after production risk. How did you do that? You took out insurance against hail or drought. But a new crocodile came into the picture, and that crocodile was the crocodile of price risk. And so the need arose to manage price risk. Not a new phenomenon around the world. For many years, agriculture and participants in the agricultural marketing scene have been faced with price risk. How do they deal with that? Basically by way of a futures market. And so in '95, under the banner of the South African Futures Exchange, the Agricultural Market Division was formed as a membership association. And we trade today the grains, white and yellow maize, the most well-known grains in South Africa, bread-making wheat, sunflower seed, sorghum, and then also soya. And these are all physically delivered commodities, and we'll get to that. Now, if you look at the marketplace, what is a futures market? A futures market basically has two fundamental characteristics. One, it's there to manage price risk. That crocodile that surfaced, the management of price risk. And then also the facility to determine what the price is. And why is it so important to do this on an exchange like the JSE? Because of the guarantee that's built into it. Now, you can manage price risk in various ways, and you can take out a forward contract. But taking out a forward contract, you're always then exposed to counterparty risk. Going over the exchange, working within what we'd like to call a pyramid structure, not a pyramid scheme, a pyramid structure where you have the guarantee built into the market. So we've changed our names over the years. We started out as SAFEX, the Agricultural Market Division, but still now, under the JSE, we provide the same type of risk management facility, the same price discovery that we've always provided. Why do you need that? Well, agriculture, as I said, is notoriously risky. You just have to have a look at the price graph of the maize price. Up and down, up and down. Why? Because obviously, determinant on the weather, determinant on a number of things, the price of maize varies. If you look at the price of maize in South Africa, even more factors which underlie the riskiness of it. So not only do you have the South African production with demand and supply, but you have the production and the demand and supply in our neighboring countries. Is that going to generate actual exports or export opportunities? Then you have obviously the world situation. What's happening in the US? The major producer of corn in the world. Huge amount of corn. And a lot of that corn, as we know now, perhaps 1/3 goes into ethanol. So again, that situation is very important, how it impacts onto the South African price. On the import side, of course, what's going on in China? The amount of not just corn that's being eaten in China, but how many chickens, because of course chickens eat corn. So those are the factors that really influence the price of maize in South Africa. So you don't know what the future holds with regard to the price. If you knew what the future held with regard to the price, well, you sure wouldn't be looking at this podcast right now. You wouldn't need to. But we don't know what the future holds, and therefore you need to manage your price risk. And how do you manage your price risk? By the instruments that we offer. We have a futures contract, and we have option contracts. Fundamentally, a futures contract is a contract between two people on a standardized basis where both the buyer and the seller of the contract have an obligation. Now, being a standardized contract, you can offset that obligation by a reverse transaction. But if the contract goes to expiry, then it goes into delivery. And how do we deliver? We don't see trucks arriving at the JSE in Sandton with maize. No, we do it all by way of a silo receipt. And so in my office right now, believe it or not, I've probably got a few hundred tons of maize in a safe, very, very secure. But that's how the delivery, the physical delivery takes place. And where does delivery take place? Well, there's various silo locations around South Africa, centered off a central point, which we take as Randfontein, which, as you know, is very close to Johannesburg. And that is the central point from which location differentials are then calculated. So deposits of maize can basically be delivered into the various silos around the country, and that actual transfer of the ownership takes place by way of a silo receipt. If you want to know more about the market, obviously the place to go is where you're right now on the internet to find out more information about exactly how this works. The guarantee I was talking about takes place, as I said, through the pyramid, because as a client, you trade with a client, an anonymous client on the other side, but when you trade, you put up a good faith deposit, what we call an initial margin. That then secures the first level of risk. And that's placed through a broker, and as a client you sign an agreement with a broker, a registered broker. On the agricultural market, the commodity market, we have about 50 such brokers. If you don't know where to go to your bank, a great place to start. You can always check out the list of brokers, members through which you can trade on the website. So you work through a broker. A broker has certain criteria before he can act as a broker on our market. And that broker has to have a clearing agreement with one of the large clearing banks in South Africa. And that's where the guarantee in the market comes from. So the transaction is guaranteed from the top down, but also then because of the deposit that's paid, you have the bottom-up approach. Who participates in the market? Well, you have what we would term hedgers, those people who are actively involved in the market, for example, a farmer who's producing the product, or a miller who's using the product. But then you also have what we call speculators. Speculators, not a dirty word, because the farmers, the millers, those participants in the market want to offlay their risk. The speculators are those who are prepared to take on that risk in order to make a possible profit. And yes, profits can be made, but of course losses can also be made. The internet will give you a lot more information about the market. It will also show you, for example, a volatility index, so you can get an idea of how volatile the white maize price is. We do not know what the future will hold. There's price risk in agriculture. Therefore, the market is there to enable participants in the market to manage the price risk on a guaranteed basis. Thank you.